Purchasing a property is probably the largest purchasing decision you will make in your life. And for some people out there, the idea of leverage or a mortgage is quite alien. And in today's video, I want to break down what it is, how you can save costs, reduce risk, and help you buy the best property. So what is a mortgage? Well, it's a loan that is secured, I'll link back to that, against land, or in this case, property. And what it means by being secured is the loan is protected by the asset, i.e. the property. What this does mean is if you decide to not pay at any point, the bank has a right to take the property off of you, also known as a repossession. So the first thing you need to consider is affordability. And this is both internally and externally. So what do I mean by that? Well, externally, we're talking about the lendability of you as an individual. What they will do is a multiplier typically of what your income is minus a couple of expenses. So for example, if you've got ongoing fixed expenses that aren't going to change, they'll take account of that. Now, normally, if you are the sole purchaser, it will be between 4 and 5 times your salary. Give or take, you need to talk to somebody about this for your personal situation. But if you're earning 20 grand, they will loan you between 80 and 100,000. But also if you're buying as a couple or there's a second person, they'll also take account of the second person, but to a much smaller degree, usually about 1.5 to 2 times their salary added in. And that's not the purchase price of the property, that is the loan they are willing to give you. For an investment property, it's slightly different. So when you're purchasing an investment, really it's looking, one, do you have a stable job? Usually they're looking for about 25 grand, but then the actual purchase of the property has very little to do with your salary, your income, your expenditure, unless you're really bankrupt. What it's actually based on is something called rental coverage, i.e. if you worked out your mortgage at X%, I like to do it at 5% to make sure I've got some risk, and you average that over a year, they look for how much the rent covers it. Normally, they're looking for about 130%, but some are looking for more. Let me give you an example of that. Let's say the interest payments are £6,000 a year, so £500 a month. And let's say that £500 a month, let's say they're looking for rental coverage of 130%. Well, of that £6,000 a year, they're looking for 30% on top of that. So 10% is 600, times that by 3, that's 1,800. And so your rental will need to be the 1,800 plus the 6,000, 7,800 per annum. And what this coverage does is acts as a protection measure for the bank just in case it goes to a void every now and then and somebody stops paying you rent. Then also you've got your internal metrics, i.e. just a gut feeling of what you can actually afford. And I'd recommend using LendLord for this to jump on it, get your analysis done so you can actually break down exactly what your affordability is. And if you end up transferring it into an investment, getting an understanding of the metrics moving forward. The third thing we need to go through is the actual process of getting a mortgage and breaking that down step by step. But before I go into that, I'd like to say a little something about today's video sponsor. So today's video sponsor is LendLord. LendLord is an incredible app and piece of software that you can both get on your phone and on your laptop or computer. And I use this for my entire portfolio analysis. It allows me to analyze properties properly, which you've probably seen in some of my videos, but also allows me to reliably predict the outcome of my long-term property investments. What I also like using it for is periodic reviews from my leveraging point of view and my lending point of view, understanding when rents are due, insurances are due, and maybe when a refinance is coming out. Well, how I like thinking of it as is Experian as for your credit score, but for your property portfolio. So it's a great place for you to get an overview of it, see everything in one place so that you can correctly and predictably assess the current situation and future of your portfolio. If you're interested in this, they've got a free version available right now, and you can get access to this by clicking the link in the description. When you're going through the process of purchasing a property, you need to make a decision. Are you going to go directly to the bank, or are you going to use an intermediary? An intermediary is usually an IFA or more than likely a qualified mortgage broker. Now, I believe price is what you pay, value is what you get. You can go direct to the banks, but honestly, you're going to get cut out from a load of lenders and you won't get the same prices that they actually pay through an intermediary. You know, you might think, well, that's random because surely they're going to lose money by doing that anyway, by paying the broker. Yes, but obviously the broker's job is to generate a load of mortgages for them and for you. So I prefer to use a broker and go through the step-by-step process. The first of which is the lender or broker asking you a series of basic questions, doing some checks on you. It won't do a hard credit search, so it won't affect your credit rating or anything, but it's going to get some basic information. Once you've then found your property, you're then going to get what is known as an MIP or an AIP or a DIP, okay? I know it's really confusing, they're all the same thing. MIP, mortgage in principle. AIP, agreement in principle. DIP or DIP, decision in principle. Most of you will see MIP or AIP. What this is a hard search, okay? This is where they will search your credit file. It has a temporary hit on it, so after 3 months, 6 months, it won't matter anyway. But it's really to make sure you've got no court county judgment, CCJs, or missed any payments in the last couple of years and things like that. Really just to make sure you're a safe person to lend money to, for you to borrow the money to purchase the property. Once they've then done this, we move on to the next stage. At this point, they're going to do a full fact find. So they're going to delve into your personal situation a bit more, how much you're earning, how much your partner's earning, if it's a personal purchase and you've got a partner, or they're going to look at the individuality of the case of the property. What's the rent on it? What's the coverage? What's the area like? If it's a buy-to-let, they'll also do analysis on how many rental properties are in the area, especially if it's social housing, where they don't want too much social housing because it impacts mortgageability and capital growth in the area. And essentially, they're doing a risk analysis. At that point, once they've done all of their checks, they will send out a valuer. And when I say a valuer, I don't mean an estate agency valuer, which is not a true valuer. It's more of a marketing term. I mean a RICS accredited valuation, okay, Royal Institute of Chartered Surveyors. So they will go out and value the property and say, hey, you're buying this at 100, but is it really worth it? They will come back and say, yes, you are all good to go. And then what they will do is submit their binding offer. Now, you won't actually hear that term mentioned, but a binding offer is a law enforced offer. Can they pull it back? Kind of, but it's incredibly rare to do so. At that point, you have got your mortgage offer, and technically, if the legals have been caught up with, you can draw down that mortgage and be ready to exchange and complete on your chosen property. Number 4, despite what they may have told you, size does matter. I'm sorry. I'm talking about deposits, of course. Well, when you're putting in your deposits to purchase your properties, the bigger the deposit, the safer it is for them and the more risky it is for you. So typically with a residential house purchase, you will put in around 10% deposit. You could put much higher if you want, and there are some 5% deposits, but typically a 10% deposit. So on a £100,000 property, you put in £10,000, the mortgage company will put in £90,000. On a buy-to-let property, you have to put in typically slightly more. Normally, it's 25% of your money, 75% of the bank. So the same property, you would put £25,000 in and they would put in £75,000. Now, why is it that there's more on the buy-to-let than there is on a residential? Well, because you are putting somebody else at risk due to your financial negligence, and the bank's aware of that. So likely what they would need to do is put somebody else on the street or in another house or kick them out of the house because of you screwing up if you don't end up following through with your financial obligations. Whereas if you have not followed your obligations, then they feel more comfortable doing that. So there's a lot more complications with evicting people and then repossessing a buy-to-let property. But why does it actually increase your risk by putting in more money? Now, this is logical because they have what is known as a first charge on the property. I don't know why I did that. It is a first charge on the property. And a first charge on the property means that if you default in any way, they have a right to take the property from you. They can sell the property. It's then in their ownership and they can do what they want with it. So the more money you put in, whether you've put in 10 grand, 20 grand, 30, 40 or 50,000 pounds on this 100,000 pound property, that just means they've got the same security over the property with a lot less money at risk. What that means for them is the returns that they're asking for, i.e. the interest payments, they're directly correlated to risk, and so the lower the risk is for them, the cheaper it will be for you. That might sound good, but if you're an investor, you want to think about the opportunity cost of having that money in your pocket. And seeing as mortgage interest is the cheapest interest you can get out there, can you make more than the 3, 4, 5% that you'd be paying them by investing it elsewhere? Probably. So if I were in your shoes, what would I do next? Well, the first thing is jump onto LendLord and analyze the properties in your area. It makes it really simple, and they are today's video sponsor. There's a link below in the description, completely free to sign up and test it out. First thing I do is go over to the analyzer section. There's a load more which you can find out when you're on there, but go in there and find out, even if it is a residential purchase where you're going to live, what would you get for it if you were to rent it out? So jump on there straight away. And the second thing I do is find a decent broker, because a decent broker is not just going to understand that what you want from this property. They'll have a more holistic approach to see where you are, where you want to get to, and match up the best financial product for you. Hopefully this has been of value. If you are new to the channel and you want to find out more about property, and more in particular property investment, then make sure to hit subscribe and the notification bell. And if you got value from this video in particular, make sure to destroy the like button, and I'll see you in the next video.